Welcome to Revere Asset Management's Your Money with Danny Stewart.
The market will always overshoot to the downside and to the upside.
And Don Vandenbord.
Because it's not how much you make in the markets, it's how much of that you can keep.
Is the stock market finally getting weak? A major sell-off? Or is this just a minor pullback? A buy the dip, if you will? Well, or could it be just an economic crisis like burn it to the ground, like Michael Burry says, one of the guys on The Big Short, the guy that called 2008. Now, he's been wrong a few times too, but he's caught a couple really, really big moves and made lots of big money. So, are you scared? Do you feel comfortable buying at these levels? I'm putting those in air quotes, buying at these levels. Not sure what these levels are, but we're going to find out. So there is a big rotation going on as we speak. Where is the money flowing? Is it China real estate? Is that the canary in the coal mine? I remember about a year and a half ago, I was talking about how Chinese real estate was in big trouble, and China, the government, poured a lot of money into it and kind of papered it over. But now it may be catching up to them. And a lot of the Chinese people, they don't trust the stock market, so they put lots of money in real estate. Well, if real estate really starts to fold in China, they're going to pull in their talons and stop spending, and it's going to slow the Chinese economy, ergo the global economy, down. So, or is it our economy, our fears over here? Or does it matter? If you have price equals truth, no exceptions. See, folks, there's always going to be a doom and gloom story out there somewhere, okay? And all the while, the markets climb a wall of worry until it doesn't. That's when you got to be careful. That doesn't. And Don always says more losses or giving up gains, opportunity cost, have been lost trying to avoid the next bear market than the bear market itself. I've got lots of people, lots of listeners, lots of prospects that want to come on board, but they're scared to death. They're scared because we're at these levels. The market's high. So how will you know when to buy, hold, or sell? What will you know when to do it, how to do it, and why to do it? We're going to go to Team Revere to discuss all of these right now. And remember, stock nerds, here at Revere, you can always send us, you don't have to even send us a formal statement. You can just send us a CVS file or Excel spreadsheet with just the ticker and the percentage of your portfolio. The percentage has got to equal 100%, obviously. And we can put it in our screen, our risk measure. Don will talk about that, and it'll spit out and let you know how risky you are. Okay, because how risky your portfolio is compared to the stock market. See, you've always been told it's about your risk tolerance. Actually, at Revere, we believe it's about market risk, sector risk, and individual stock or investment risk. You got to manage the risk of the asset, and the market's time horizon, the stock market or the bond market's time horizon, is more important than your time horizon, because the market will run over you. If you were bonds because you were old and conservative in 2022, you lost more than the S&P. You lost 30%. Bonds got slaughtered, but you were told bonds were safe. They are normally, but sometimes, especially in inflationary times, they're like kryptonite. So what's in your portfolio? Let's go to Team Revere and find out what should be in your portfolio based on probabilities and based on price equals truth. All right, Don, I set you up, man. Hit it out of the park, baby.
Let's do it, Dan. So we've had some, if you've been watching the nightly videos, we've been noting the weakness and the whipsaws that have been going on in some growth names. Some of them completely broke down. Others held their 21 and or 50-day moving averages, but we've also seen some shakeouts relative to the indexes. Particularly last Thursday and Friday and this past Thursday and Friday really look very similar. So 2 Thursdays ago, we broke the 21-day moving average. That Friday, we broke the 50-day moving average, but put in what we call a hammer, which is you put the lows in and then you rally. And we rallied up through this key red line, which is the 50-day moving average. Yesterday, Thursday, the 13th, was a terrible day for growth names. And then this morning we opened up to a gap down. We bottomed within the first 5 minutes, and we're putting in another hammer as of right now, getting back above the 50-day moving average. Now, we talk about on our trend gauge how we invest across 3 times on the indexes and also leading stocks. Leading stocks have been weaker than the indexes as money has flowed into value names over the past 2 weeks. And also notice during this uptrend that started back in last April, how all pullbacks were contained. Here's one close below, here's one move below and close right on. Here's another test. But the slope of the 21-day moving average continued to trend higher until we had the tariff tantrum here. And this was the China actually Trump going off about China, and we had a hard move down, but we held the 50-day moving average, but it flattens the 21-day moving average, and then you see moves up, down, up, down, up, down. These are the times when we are really backing off of our exposure in the market. The 21-day moving average is acting more like a ping pong net or a volleyball net than it is a source of support for the indexes. We come out of that, we work our way higher, the slope goes higher, the first 2 tests of it hold, and then we have a hard break again. That was the break last Thursday. And then again, the 21-day moving average starts acting like a ping pong net. Once again, we had 3 closes below it. We broke it on Thursday. We broke that and the 50-day on Friday, but now we're putting in a hammer. This hammer doesn't mean that we understand when the wind is at our back, a lot of the charts are broken for leading stocks, but there also are some new leaders that are holding up. There are also some new leaders that pulled back hard but are reasserting themselves. But what we're watching right now, we did not break the lows of last Friday, so we're continuing to make higher lows. As of right now, we're making lower highs, which means we're putting in a type of a pennant consolidation. And then the question is, how will it resolve, to the upside or the downside? So the lows of today are important, as were the lows of last Friday important. Then we need to get back above this green line, the 21-day moving average. Very often that can act as resistance on the way back up. It wasn't last Monday. That was a report that they're going to come to an agreement to reopen the government. The market rallied for 3 days. Then when they actually signed the legislation to reopen the government, it was a sell the news event on Thursday, follow through to the downside this morning, but rallying right back into this flat, barely declining 21-day moving average. So this is the rubber meeting the road on the S&P 500. That's what we're going to be monitoring very closely the rest of today and going into the beginning of the trading week next week. Let's go to the NASDAQ 100 very quickly. Similar action, but we did undercut the low of Fridays, but very often that 2 Fridays ago, but very often that's just a shakeout. And that's what it's looking like in this case, because we're putting in very similar action. We've regained the 50-day moving average with this quote-unquote hammer bar or hammer candle. We've also got a flat 21-day moving average, and we're coming into that. And we need to see if the NASDAQ 100 and the big tech names that rule it and that rule the S&P 500, can we get back above that? Also notice, and this is when the leaders, the weakness in leaders started to occur a little bit more than 2 weeks ago. The NASDAQ 100 that had led this rally up started to lag. It's even more prevalent if you look at the FFTY, the Investors Business Daily 50, the IBD 50. This looks extremely worse, all the way down to near touching the 200-day moving average. And this is a better reflection of what actually is going on with growth names. Notice that we made a lower low on this relative to the shakeout 2 weeks ago. That was last Friday. Now, yesterday and today, we made a lower low there again, and we haven't even rallied up to get back above the low of that shakeout day 2 Fridays ago. That would have been on the 7th. So very clearly, and one look at the relative strength line tells you all you need to know about how strong leading names have been. They absolutely haven't been. We've been on our trend gauge making a lot of changes, both to the main arrows and the sub arrows on the leading stocks, which is we tie that to somewhat to the RG8 and somewhat to the 21 over 21. It's a bit of a judgment call. Some have held up, some have broken down, but you can't go strictly by that arrow for leading names. You have to look at every individual chart and gauge whether or not they're acting fine, pulling into an area on low volume where they should find support, or are they completely breaking down? Things like the quantum names, here's IONQ, completely broke down. Other names like, let's look at LEU, a speculative uranium name, completely broken down. And some leading names like here's Raytheon, aerospace defense, just barely touched the 21-day moving average. AMD, a little bit more choppy, but they had a big event earlier this week. It reacted bullishly, sold off for 2 days, but undercut and reclaimed the 21-day moving average. This is acting extremely well. Let's look at leaders like Micron. Didn't even come into the 21-day moving average. Sandisk, we used this shakeout today under the 8-day moving average and a 60-minute stochastic cross to get an entry into this. It barely pierced the 8 EMA, came nowhere close to the 21-day moving average. So the leaders, you take it on a stock-by-stock basis. The indexes, the S&P 500 looks fine because remember, and this is a reason why we use it as a core holding in the portfolio, because it reduces the volatility. Compare the look on the S&P 500 to the look of the FFTY. They're not even close. So why if you strictly use growth names, which there have been times in the past at Revere throughout we're on generation 4 of Growtection right now. There have been times where the indexes didn't play as prominent a role. I learned back in 2021 what happens when growth stocks quickly go out of favor. And we just won't get stopped in that trap again. And that's why our equity curves grow from lower left to upper right, like driving from Arizona to Maine without any detours down to see Dan in Texas. We don't want those harsh sell-offs.
You don't want to see Dan in Texas. Wow.
I can just call you Dan. It's that simple. I don't have to go see you. So this is the big divergence that we've seen lately, and that's the indexes versus what's going on with the leading names. Just compare FFTY to the S&P 500, and it tells you everything that you need to know. And that's why we split our portfolio basically in two: half with the indexes, including leveraged ETFs, half into leading names when they are in favor. The beta, the volatility adjusted beta right now on Growtection, as long as we're above the 50-day moving average, there's two targets that I like to maintain. One is at least a 0.6 to a 0.7 beta in the S&P because it's working fine. All we've seen is a big rotation out of growth names into value names. Let's look at SPYV. This is the value half of the S&P 500. All it did is touch the 21-day moving average. Let's look at SPYG. This is the growth half, much worse, pierced the 50-day moving average and is below the 21-day moving average. And you can see the relative strength in the growth half of large cap stocks. It's more prevalent when you go to the mid caps and the smaller caps. The growth got hit, but the index is held up because money rotated big time into value sectors like XLP. Now, this looks terrible. But look at the relative strength of it over the last 2 weeks. Money has flown into staples. An even bigger example is XLV, the healthcare sector. This is a defensive sector. Money has flowed into healthcare. So it's a matter of monitoring the sectors, keeping that core in the S&P as long as it obeys the various moving averages, and monitoring the health of the leading names. The bulls couldn't really ask for much better than we're seeing today from a shakeout perspective. And that something I keep in my notes every day, 05 equals low. We bottomed in the first 5 minutes. I also write down what the range was for the first 30 minutes. There's the 64.47 bottom. 67.05 was the high for the first 30 minutes. We blast through that. That tells us that the bulls are back in control, at least on a short-term basis, at least today. And then you just monitor the individual names, what's showing relative strength, and are the indexes going to hold the 50-day moving average by the end of the day? That would be great. That would be good. It wouldn't be great. If we closed right here, it would be great. If we get back above the 21-day moving average, that would be excellent. We're not making any guesses here. We're going by what the market is actually doing and then dipping toes in as it calls for. I didn't finish my thought on the beta. Right now, we're at 0.65 in the indexes, and the individual names I own are around a 0.35. So less than half of the exposure for growth names as there are in the indexes, and that's because the growth names haven't been working. Let's show what we're still holding on to. AMD, we got stopped on Tesla several times earlier this week, and then the final position shook out below here yesterday. It's rebounded. I sold it around 392. It's up to 409. Did I do the wrong thing? Maybe. I can always buy it back again, but it ended up booking a 20% gain when we broke here, and the remaining was about a 12% gain when we broke here. And it was 4 times what the index did. We always write down what the S&P was trading at when you make a buy, so you can see if your stock is outperforming the S&P. It should be by a factor of at 2 to 3, or you're not getting the return for the risk that you're putting on by buying an individual name. What else do we still own? NVIDIA. Undercut the 50, but reclaimed it today. It's below the 21. This is a small position. We also own TER. This is one of my favorite names. It acted extremely well. We got stopped on 2/3 of it when it broke below the 8 yesterday. I say this all the time. Leading stocks should ride the 8 EMA higher. This one didn't. It was a victim of the overall market, but we still have a third of the original. We still have the original buy. The 2 subsequent buys we've been stopped out on. We can buy them back at any time, but we undercut the 21 and we're back above the 21. Didn't break the low of the gap up day, so we're still holding that position. MongoDB has been showing great relative strength. Undercut the 21, but reclaimed it. Never added anything to our initial buy on this, so we're still holding on to that piece of it. I mentioned that we added Sandisk today, SNDK, taking advantage of that 60-minute stochastic cross that I use significantly. I didn't get this whole run up. But immediately, Sandisk was one of the names that turned green this morning after the shakeout. And that signal, it's a short-term signal. Arguably, it's very extended from the 21-day moving average and the 50-day moving average. But I'm not playing it against those moving averages. I'm playing it against the 8-day moving average using that LREP, low-risk entry point shotgun technique that I talked about in our podcast 2 weeks ago and on IBD Live. So Sandisk, TER, NVIDIA, MDB, AMD didn't get stopped out of this either. Undercut the 21, but is back above this 250. We're basically flat on this. This was after the big volume move higher after the presentation the investor presentation that they had earlier this week, where they raised their margins, raised their sales projections, and it's been a leading name. From here, had a nice base, gapped up, great relative strength there. We're looking for it to reclaim this. There have been a lot of AI data center type chips and infrastructure that have really taken it on the chin over the last couple of weeks, but this isn't one of them. This is one of the leading names. You can see it's hanging out near the relative strength at a new high, and we're looking to add to this. So we pulled the weeds. The flowers were left. Now we're looking at watering the flowers again, as long as we stay back above those key levels on the indexes, and the positions that we maintain in leading names continue to hold up and show relative strength.
All right. Well, listen.
That's a pretty good summary, Dan. I'm sure you have questions.
That was not really a Cliff Notes version summary. That was like a good overview, actually. Folks, I got a question for you, the listener. Does your advisor sound like that, or are they asking you for a tea time or lunch? We don't go to lunch when the market's open normally, at least 3 or 4 of us at a time, are always in front of the computer, right? And we don't play golf too much. Connor does, but Don and I don't. Anyway, just wanted to know, because this makes a huge difference. This is how you manage risk. So in a nutshell, growth stocks were actually doing really well in the place you wanted to be all of a sudden till just recently, and now there's a big rotation into value. And even small caps and overseas really weren't the place to be. Now that, Don, are small and mids starting to heat up, or are they still lagging?
Let's take a look at IWM, the small cap ETF. Relative weakness over the last 4 weeks. Not a surprise, because this is a risk on, risk off indicator for the markets. When these are outperforming, it's normally a strong risk on situation. We did undercut the lows of last Friday, which is something we didn't do on the S&P 500, but we're putting in a similar hammer today, right now. The leading index has been the Dow. Why? Because it's a value type index. Note the relative strength here over the last 2 weeks. In the Dow, it hit all-time highs on Wednesday, pulled back along with the rest of the market today, and it's underperforming today. Why is it underperforming today? Because growth is outperforming value today, and this is a value index. Here's MDY. Mid caps under the 21, under the 50, under the 8, relative weakness going back for 3 months. And the equal weight S&P 500 RSP has been showing relative strength over the past 2 weeks. You typically see this when growth names and the big cap names go out of favor. This is an equal cap weighted index, showed relative strength over the past 2 weeks as money came out of the NASDAQ 100 tech type names and other growth leaders and flowed into the value sectors. The value sectors have a much bigger allocation in the RSP than they do in the SPY, or what we buy, the SPY M. And these are types of things that we monitor every day, all day. Individual sectors, leading names, and the indexes, and following the trend on all of them.
Yeah. So, folks, when you hear about that asset allocation rebalancing story where they rebalance one day a year, that one day, 365, how do you know that's the right day? I mean, the market could go down 20% a few months ago, and you should have rebalanced 2 months ago. Here at Revere, we're rebalancing on a daily basis based on risk, and we're going to move the money. We're following the money flows, really is what it is, relative strength of where the money's going. And so it was large cap growth for for most of the year, and now it's just switched to large cap value. You should stay away from the emerging markets. You should stay away from small caps unless they heat up. And so price is truth, no exceptions, and you want to overweight what's working. And in a good, healthy market, usually growth stocks will be leading and the whole market is good. But sometimes when growth stocks sell off, there's a flight to quality, they call it, and value will be good. That's why we kind of got a little bit of both in there. But sometimes when you got a really big sell-off, like a bear market or even a correction, even the S&P will go, and at that point, you'll clear the deck. So we're watching, and we'll move out of growth stocks to value. And if value start to give, we'll even go flat or hedge or move to cash. That's how you don't get creamed. All right, Don, what does the team have?
Well, we're going to go to Ted first, and he's going to talk about a couple of names, one of which is acting pretty well, and a couple that are not. Take it away, Ted. I'll run the charts while you do the talking.
Yep. Thank you, Don. So typically one type of analysis we do in the markets is gauging news relative to price. And the first one is AMD. Don has it on the screen. And today it's acting really well. Hammer off the 21, reclaiming the 8. But 2 days ago, the day Don mentioned, AMD had their financial analyst day, and they reported some huge numbers. They report over 45 billion of custom chip design with content starting in 2026, and the the CEO, Lisa Su, said they're on track to hit tens of billions in AI data center revenue by 2027, and they're just seeing a CAGR of 35%, or just annualized revenue growth of 35% over the next 3 to 5 years, and which is huge. Yesterday, the markets came in, AMD came in as well, and for our expectations on such major, I guess, projections, you would think that AMD would react a lot more violently to the upside. Although you could say it's a little bit extended and it's falling prey to the pressures of the market as well. But today it's definitely relatively stronger than the markets above the 8 and 21. And while the S&P is below the 8 and 21, as well as the NASDAQ. So the next one, in terms of the news price relationship, is Oracle. A couple months ago, it gapped up on earnings. It didn't even beat on earnings or revenues. So one might ask, why did it have such a nice reaction into all-time highs, up 10% plus? And the reason being is it was what was said on the earnings call. They said astonishing demand for Oracle Cloud infrastructure, and more importantly, they see Oracle Cloud, or they saw Oracle Cloud growing 77% to 18 billion this fiscal year, and then increasing to 32, 73, 114, and 144. So that was the reason it gapped up initially, but that has marked a high so far, and it has fallen almost 40% all the way back to the 200-day moving average, being one of the major players in cloud infrastructure and AI infrastructure as well. So this is what we call the news failure. And with that kind of news, you expect Oracle to at least hold within 5% of the low of the day of the gap day. But this just pretty much fell apart below the 821 and 50. 821's below the 50 now. 50 is about to slope down. And we're right at the 200-day moving average, which is a total expectation breaker for us for a name like Oracle. And really, there's four, how I see news and price relationship, there's four quadrants. You can have good news and then a good reaction, which is neutral. You can have bad news and a bad reaction, which is also neutral. And the significant times is when you have good news with a bad reaction, or bad news with a positive reaction. And I guess quick exercise, which was not part of my plan, was if you look at the S&P, we saw the highest inflation report at the bottom of the bear market, and we had a good reaction. That literally marked the lows of that 2022 inflation bear, and which has led to this really nice 2-year move. And now we're kind of starting to see the upside, on the upside a little bit. The market's tiring out somewhat. The government has reopened, and actually we have sold off yesterday. And something like Oracle saw amazing news as well and has sold off since too. So we're kind of juggling these two sides right now. Don highlighted many names showing RS too, so it's not a total failure out there like these 50-day bounces that Todd will actually talk about after me. And it's really this push and pull we're in right now, weighing both the positive sides and the negative sides. And that's kind of how we come to decisions based off how much exposure you want in the markets. And the third name that's completely really just breaking down and into a total downtrend now is Bitcoin. I've been talking about Bitcoin for a while now, and that cup with handle, if you're to cover that up, that's a typical setup we look for. Perfect cup with handle, had all the perfect characteristics. And to me, it's a fat pitch. That doesn't mean all fat pitches work. Um, they can still fail. That's a big lesson there. And this really has been just a lot of frustration in the last 6 months. It broke out of that cup with handle, I think that was early July, made a new all-time high, pulled back quickly, then went for another new all-time high, failed again, pulled back, broke the 50, and then in October, it went for an all-time high a third time, and it failed shortly after, and it really has just been down ever since. Quickly broke to the 200, rallied, put in a lower high at the declining 50, and now it's living below the 200-day moving average. And for us, we talk about it all the time. When something's living below the 200, it's just a no-go zone. We'll still watch it, see how it acts, since oftentimes Bitcoin could be um, just an indicator of liquidity in the environment and risk on, risk off. And Don highlighted the relative strength line. It's completely underperforming the S&P now. So yeah, even the best opportunities can fail. That is why we have stops. You just never know. It could be best setup, have the best fundamentals in theme, markets are healthy, but still can just fail. So always have to be prepared for the downside.
I love
Great
it, Ted.
stuff, Ted.
Yeah, I
Go
love
ahead,
it.
Dan.
He said the government reopened and the market sold off. I just thought that was funny. Go ahead, Don.
Yep. One of the points that Ted made is you never do know you could have the best setup. This was a near perfect setup on Oracle. Great news, massive volume gap up. We're in the middle of a year-long study with an outside data firm where we're going to classify every gap through history, compare them to the newer gaps that happen, and classify them into different profiles. And that gives us an expectation of behavior for those gaps. We very clearly know that there's alpha involved with gaps. We don't know exactly which ones are going to show the greatest alpha. They happen all the time. This is an example of one of the ones that Ted talked about, four quadrants. You can apply that to gaps too, because you want to consider what type of a market you're in. We were in a great market with this. Very often with these, with gaps, when you look back through history, you see things like this where it breaks below the low of the day, but it normally happens in a weak market. You come back into the 8-day moving average and you bounce. But notice while this was showing massive relative weakness, the market was trending higher. So that's a massive big red flag when you've got a big gap up with volume, great forward-looking report, great hype from the CEO of the story, and sometimes it flat out just does not work. And you have to be able to pull the trigger and hitting the exit and move on to the next name that is working. They could have a very similar setup. Some work, some don't. The low of the gap up day with a little bit of overshoot is the ripcord that we use to get out when it's not working. Looked like it was a tease as it tried to get back into the range of that opening gap day, but it never exceeded the high volume close, and the market was acting well and relative strength was lagging. It's a matter of putting all the puzzle pieces together to come up with the most likely scenario for a name. Another thing about Oracle is they're taking on massive amounts of debt, 417% debt here. They're taking on massive amounts of debt to finance their AI expansion, while a lot of the other big names are using cash flow from operations, not taking on debt. So that's another big piece of the puzzle for Oracle. Great stuff, Ted. Let's go over to Todd. He's going to talk about some leading stocks that are pulling back, and that pullback may not have been easy, but it's looking like it may be an opportunity. And let's start with VRT, Todd.
Thanks, Don. Yeah, we've got some, top tier examples of relative strength today. And Don's already talked about Sandisk and Micron being two of the top leading names that really didn't even challenge our 8-day moving average, really. However, we do want to keep our eyes out on leading stocks that are testing the 10-week and 50-day moving average and then displaying extremely strong relative strength off of that average. And today I wanted to talk about three names which are displaying what I consider outstanding relative strength off that 50-day, which means that they're being supported by institutions. And VRT is probably one of the best examples today of a stock that closed right on the 50-day moving average yesterday. Some pretty heavy volume and closed really at the lows of the day like the rest of the market, but is showing exceptional action off of that 50-day today, which could potentially be a new buy off of that level. This is one area that O'Neill liked to buy or add on to his winners on. And you want to see that instant strong action off the 50-day, and VRT is certainly showing that today. The second name that also is showing extreme relative strength off the 50-day is Snowflake. And really, this name was just below its 21-day moving average yesterday. So it certainly was holding up much better than VRT. But this morning, it was almost like an air pocket where you had, just this huge gap down open. And this one really found support right into the 50-day moving average and opened right on the low of the 1-minute bar and just took off from there. So you want to really see that type of action where you get that open equal low and just instant move right off of that key moving average here. So that's a great example of one that's showing strong support and a strong appetite for institutional buying right off that key 50 and 10-week moving average. And probably one of the stronger examples today of one that had a pretty nasty pullback, what's holding very well, is BE, Bloom Energy. Bloom Energy has been one of the leading stocks of fuel cells, and they're being used in the data center. And it just showed a huge move up from $16 to $150 in a very short period of time. And during this whole pullback, this is really one of the only pullbacks to the 50-day moving average, which it closed on yesterday. And today it's just showing massive strength off of that 50-day moving average, and it's already probably going to be above yesterday's volume too. We're already at the average daily volume today and running substantially higher. So these are the types of things you want to see off of that 50-day moving average. And we're always looking for relative strength of the top names. And this is a great opportunity to go through your list to see which stocks are truly holding up at these key averages.
Good stuff, Todd. Something I want to point out, Grotection, we got stopped for small losses on SNOW and BE yesterday. Earlier in the week, I talked about the BE entry, how it was low risk at the bottom of this consolidation after the big volume move up on earnings. But again, sometimes it just doesn't matter. The market and how they're treating growth names trump any thought that you might have that you're in the leader and you better just hold on to it. So stopped yesterday when it broke below the 21-day moving average and the low of that consolidation. Snowflake as well stopped for a small loss when it broke below the 21-day moving average. But now I've got a clear support level, and what I'll be looking at for both of these if we decide to re-enter it is what happens when it comes into this 21-day moving average, both on SNOW and on BE. And VRT. So right now they're both back above the 50-day moving average. Great low risk entry here, but when the rubber meets the road to see if we can pyramid it or if this move up is going to be sustainable, it needs to get back above the declining 8 and 21-day moving averages. And that's what we'll be monitoring on these names going forward. Great stuff, guys. Dan, that's going to wrap it from the tech team. You can take us on home as only you can do, except when you're out and then I imitate you.
And you've done a fine job. Thank you, Don. I appreciate that. Folks, listen.
All right. If you like what you heard.
Yeah, every time I hear you say that, it reminds me of Popeye.
Does it? I wonder why that is.
Popeye the Sailor. That's who you need to put on the thumbnail, maybe Popeye. Anyway, folks, listen, if you like what you heard, please tell a friend, tell a neighbor. Just send them to revereasset.com. Up in the right-hand corner, there's a subscribe button. Put your name and email in. You'll get this podcast out on Saturday morning, and our daily market videos we do every night the market is open, a little 10-minute video telling listeners and even clients exactly what we're doing in the portfolios. We're the most transparent advisor in the world. But if you go to YouTube and just type in Revere Asset and hit subscribe, Zach will have this podcast out by, say, 1 o'clock Central, and the stock nerds get this a couple hours before the market close on Friday. So there's lots of ways to get our content, but usually our newsletter or YouTube are the easiest. And next to that is a contact us button. And if you send us an email and you want a complimentary portfolio review or just someone to call you and find out more about Revere, you can do that too. And folks, you can always call us old school at 855-REAL-WEALTH. We show you how to real professionals do it, not the pie charts or us. Don't be that person with a pie charts or us portfolio. Learn a better way to invest. We'll talk to you next week on your money, not Wall Street's money, your money.
Because it's not how much you make in the markets, it's how much you can keep. Right, Olive?